Semiconductor stocks have exploded higher. AMD, ARM, and Intel are all riding the same story: AI demand, hyperscaler spending, and data center expansion. But right now, the setup looks dangerous. Not because AI is fake, because the stocks have already moved too far, too fast. This week matters because Microsoft, Meta, Amazon, and Google are reporting. These are the companies funding the AI infrastructure boom. So the real question is, can hyperscaler spending justify what semiconductors have already priced in? Because even if spending stays strong, the current move still looks overextended. This is where the PreTradeIt dashboard helps. It breaks the move down into momentum, valuation, fundamentals, and macro context. And across AMD, ARM, and Intel, the message is clear. The sector is strong, but the stocks are stretched, expensive, and vulnerable to a reset. Start with AMD. AMD has the cleanest growth story. Revenue growth is 34.1%, and earnings growth is 217.1%. So the growth is real, but the stock is overheated. AMD is trading at 348.90, just below its 52-week high of 352.99. It is 32.5% above its 20-day EMA, with RSI at 88.9. Now add valuation. Trailing PE is 133.26, forward PE is 51.81, and price to sales is 16.37. So AMD has strong growth, but a lot of that growth is already priced in. That means AMD does not need bad news to pull back. It only needs good news that is not good enough. Now ARM. ARM is high quality but even more stretched. Revenue growth is 26.3%, but earnings growth is negative at minus 12.3%. The stock is at 234.49, close to its 52-week high of 237.68. It is 38.2% above its 20-day EMA, 57.1% above its 50-day EMA, and RSI is 87.2. Valuation is the bigger issue. Trailing PE is 313.08, forward PE is 114.94, and price to sales is 53.39. That is priced for perfection. So if hyperscaler earnings are anything less than exceptional, ARM can pull back sharply. Not because the business is bad, because expectations are too high. Now Intel. Intel has had a massive move, but the fundamentals are weaker. Revenue growth is 7.2%, while earnings growth is down 71.7%. The stock is at 82.73, near its 52-week high of 85.22. It is 33.5% above its 20-day EMA, 52.8% above its 50-day EMA, and RSI is 82.2. Valuation does not help either. Forward PE is 161.29, price to sales is 7.72, and profit margin is negative at minus 5.9%. So Intel has the weakest setup here: strong momentum, weak earnings, expensive valuation, and poor profitability. If the semi-trade cools, Intel looks very vulnerable. So across all three, AMD has growth but is overheated. ARM has quality but is priced for perfection. Intel has momentum but weak fundamentals. Different stocks, same conclusion. The move has gone too far, too fast. Now add the broader market risk. Markets are near highs, but the backdrop is fragile. Geopolitical talks remain uncertain. Oil risk is still present. Inflation risk can return quickly. And if the broader market corrects, semiconductors are unlikely to be defensive. They are high beta, crowded, expensive, and stretched. So if risk sentiment turns, semis can lead the downside. That is why the pullback now looks more likely than not. Not because AI is dead, not because hyperscaler spending must collapse, but because these stocks already priced in so much good news. Even strong earnings may not be enough if the market expected perfection. Even stable capex may not be enough if investors wanted acceleration. And even a small macro shock may be enough when positioning is this extended. So the takeaway is simple. This is not the early part of the semiconductor rally anymore. This is a reset setup. The pullback looks likely. The only question is what triggers it: hyperscaler earnings, profit-taking, or a broader market correction. But with stocks this stretched, the reset does not need a major catalyst. It only needs buyers to stop chasing. If you want to break down stocks like this using real data, the PreTradeIt dashboard is linked in the description. Drop a ticker in the comments, and we'll analyze it using the same framework. Research only, not financial advice.